The worst moves you can make in a market crash. Crashes may be frightening after all. No one wants to see their investment portfolio lose value. However, if you avoid frequent blunders when they occur, you can actually protect the value of your possessions. This is it. Before we start, you'll need to hear this. A market correction could occur at any time. It's a normal feature of market cycles. However, predicting when one will occur is difficult, and there are two mistakes in particular that must be avoided. They are: 1. Panic selling. When the value of your assets fall, it's natural to become concerned and believe the situation will worsen. You might even feel compelled to sell in order to mitigate the damage. However, in the vast majority of circumstances, this is the exact opposite of what should be done. You'll be emptying your shares, and if you sell amid a crash, and by doing so, you'll lock up your loss while also missing out on the opportunity to see your portfolio rebound when prices climb. If you bought high-quality investments with great long-term prospects, there's a decent chance your investments will recover when the market turns around, even if you can't predict when that will happen. If you remain with the program, any drop in share price during the crash will only be temporary, and your investment will ideally not only recover, but even gain in value during the recovery. During the crash, any losses you have on paper will be replaced by gains. If you don't have any investments you're happy holding during a protracted downturn, the decision will be more difficult. As a result, if you want to make quick money, you should avoid short-term trading. You never know when this technique will backfire if the market crashes, leaving you with shares of companies you can't rely on to weather the storm. Number 2, a reduction in investment. When you watch the market begin to crash, you may decide that investing in it is too dangerous and you reduce your investment. Alternatively, you might take a break from investing during the downturn and wait till the market reaches rock bottom before acting. Unfortunately, cutting back on your investment during a downturn might be a costly error. It's really difficult to estimate when a recovery will start, and it can come swiftly at times. If you try to time the market, you can miss out on the opportunity to get in before prices skyrocket. And if you're worried about buying a downturn, remember that as long as you're buying high-quality investments, it doesn't matter if the value of your assets momentarily decreases on paper. You should be able to buy at least many shares at depressed prices owing to the crash if you buy consistently during a slump. If you don't invest, you'll miss out on this opportunity to buy shares for a low price. To ensure that the fall has a minimal impact on your portfolio, stay ready and invest in the market rather than selling your current holdings. Something significant has occurred. I'm not sure about you, but when some of the world's finest growth investors give me stock advice, I always pay attention. 2 new stock recommendations have just been disclosed by our award-winning analysis team. Over the last 17 years, they've doubled the stock market's return, and while time isn't everything, their track record demonstrates that getting it on their stock pick early pays off. Investing in this stock could be similar to purchasing Amazon in 1997. Consider what might have happened if you had purchased Amazon in 1997. A $5,000 investment back then would now be worth almost $4 million. You can't travel back in time and purchase Amazon from 20 years ago. However, our experts have discovered what they believe to be the next best thing, a unique stock with incredible growth potential. This stock has been compared to an early Amazon.com because it has hundreds of thousands of business customers already signed up. Will there be a market crash this year? Stock market crashes, on the other hand, cannot be avoided. They're an unavoidable component of the investment process, as well as the price of entry into one of the world's most powerful wealth producers. A $20 bill from a paper airplane that has crashed and folded into a financial paper, the signs are pointing to a possible crash. There are several reasons to assume a stock market crash or sharp downturn is imminent. For instance, each of the preceding 8 bear markets before the coronavirus crash saw the S&P 500 drop by at least 10% within 3 years. To put it another way, no bear market bottom bounce is ever as seamless as this one. It's a process and it's full of conflicting emotions. A stock market meltdown could also be triggered by value according to history. The S&P 500's Shiller price-to-earnings P/E ratio, a measure of inflation-adjusted profits over the past 10 years, is approaching a 2-decade high and is more than almost double the 151-year average. Worse is the S&P 500 has lost at least 20% of its value in each of the previous 4 times the Shiller P/E has moved above 30. Even if we don't enjoy pessimism, stock market disasters are unavoidable. When the stock market plummets, it's a great moment to invest. On the other hand, it's a good moment to get a good deal on a wonderful company. This is because every crash and share price downturn in history has been wiped by bull markets. Crash sales are nothing more than just before sales events when you buy outstanding firms with a long-term attitude. How to avoid a market crash. Number 1, put money into savings. Only when you sell at a loss do you lose money in a stock market meltdown. However, if you don't have any emergency funds, you may be forced to do so. A job loss or an unforeseen large bill could leave you with little choice but to raid assets that have just collapsed if you don't have enough cash on hand. Aim to have 6 months worth of living costs in a bank account or CD. Keep investing to obtain the full 401k employer match while growing your rainy day fund if you get a corporate match. However, you should seriously consider deferring other investments until you have enough emergency reserves. Number 2, set aside money to invest in the stocks on your watch list. Not everybody can stomach putting more money into stocks after it has plummeted. Make a stock watch list and set away extra money in a savings account if you have a high risk tolerance, a large emergency fund, and no credit card debt. The important thing to remember is that these are stocks that you would want to purchase even if the market hadn't recently fallen. A bad business that you bought for a low price is still a bad business. Number 3, check to see if you're overexposed in one area. The S&P 500's top 10 equities are primarily tech stocks, accounting to 27% of the index's weighted. You may be too exposed to the technology sector if you possess S&P 500 index funds and individual shares of these top 10 companies. There's no reason to leave your victories for that. If you have more money to invest, you could wish to vary your portfolio some conservative stocks, which are more reliable even during a bad market. Consumer staples and utility companies are outstanding examples of stocks with consistent demands regardless of the economic cycle. Number 4, sell any stocks that you do not want to own in 5 years. If you have stocks you've been intending to sell, now is the moment. This isn't something you should do merely to avoid a stock market crash. If you have a stock in a firm that has lost its competitive edge or no longer matches your investing thesis, you should sell this while the marketplace is still strong. The same is true if you need to withdraw money. If you don't think you'll need money in the next 5 years, you should avoid investing in stocks. Number 5, don't put your money on the line. Margin allows you to borrow money from your broker in order to increase your investment. When the market arises, it's a good thing since you can increase your profits. However, your losses are amplified. You lose 50% of your money if you invest $5,000 in a stock that falls 50%. However, if you invest $5,000 of your own money and $5,000 of your trader's money, you've lost over 100% of your investment because you'll owe your brokerage $5,000 plus interest. Number 6, do some research into previous stock market meltdowns. Finally, remind yourself to remember market crashes are common. If you invest in the S&P 500 in a given year, you have a 73% probability of making a profit even if the market drops today. Your chances increase to 87% after 5 years, and the chances are 94% during a 10-year period. You would never have lost money investing in the S&P 500 over a 20-year period at any point in history. The moral of the story is to keep your cool and avoid making snap decisions. A new stock market crisis may be well on the way according to history, but it will almost certainly be followed by a recovery. And that will be it for today's video. Thank you for watching. Subscribe if you haven't yet, and turn on the post notifications, and we'll see you on the next video.